right, thank you. So I'll introduce one by one really quickly and let everybody tell their own stories. And then we're going to go through a handful of questions. Love kind of interactivity from the group if there's things you'd like to hear more about. I think the thesis of this panel is not just funding, but helping to better understand the creativity that is available for funders, for buyers and builders. And I talk to so many searchers, so many folks that want to buy businesses. Maybe it's their first time, maybe it's their 10th time. Too often, they struggle with this idea of capital. Or how much capital do I need? When do I need to validate that I have that capital available to me? And when and how do I value the business that I want to buy? And I think this panel today with these four that are with me really can give a lot of credibility. So first, Earl Foote, tell us a little bit about yourself.
Sure. Thank you so much, Brian.
Yeah.
It's a pleasure to be here with all of you today. Great to see some familiar faces as well. My name is Earl Foote. I am founder, CEO of a managed IT and cybersecurity services provider named Nexus IT, actually celebrating this month our 27th year in business. I'm sitting on the panel today because we have been executing our own founder-owned, founder-led M&A platform. We have 8 transactions under our belt of buying other managed service providers or managed security service providers. And we just raised around our theses in a very creative way. So I'm here today to kind of share some of the things we've learned in the process. I'm all for empowering operators, owners, builders to be able to do things, to execute their vision. And there are ways to do so without selling your soul, without selling your mission down the river. And that's what we've been up to. So happy to be here, happy to share some ideas with you all today.
Thanks, Earl. Crystal Balby.
Well, I too am very excited to be a part of this event and feel privileged that we were asked to be here. I am the founder and CEO of SmartLink Financial, and we are a brokerage. So the idea is that we have the ability to go out and look for capital in many places. We have over 100 different lenders that we work with. We have many private investors on board. I created SmartLink because I knew that when it comes to buying and selling businesses, doing commercial deals, there's not a one-size-fits-all. So this really gives us the ability to stack capital, look for, different types of capital that may be needed for a certain project. And we are here to serve and help you any way that we can.
Steve Austin.
Yeah, I'd like to echo what everybody's saying. Very, very happy and grateful to be here. Thanks to Nathan and Lacey for putting this together. Ultimately, Revitalization Unlimited, we are a very specialized private equity firm. We're always looking to potentially buy businesses, buy real estate, but really at a very high level, to channel my inner Jamie. What we do is we allow you to convert 50% of your tax liability every year into income-producing assets. So anybody in the room that pays taxes and wants to pay less is probably worth a short conversation with us to learn how we can do that for you. The way we do that is through our preservation of historic buildings in urban downtown markets, and then through the acquisition of industrial manufacturing businesses. So it's a little bit about us.
Great. And Dustin Snyder.
Hey, everybody. Great to meet so many of you already today. It's a great group. Grateful to be here. Honestly, didn't know I would be sitting on a panel 2 weeks ago. This was kind of a spur-of-the-moment thing, but that's just how I've come to learn how Nathan kind of rolls. I'm a director of a firm called AltaView Advisors. We all do valuation in some regard. Most of us do business valuation, which is my focus, and then we have a handful of professionals that do real estate. And so I think that's why I'm probably on the panel today. Is as part of funding, we got to know the value of the asset that is probably going to make up the collateral.
That's great. Before we start, can we just get a show of hands? How many of you are owner-operators of a current business in the room? Okay, great. What about looking to acquire a business? All right, and then service providers. Some plenty of overlap. Okay, so to maybe kick off, Earl, you and I were talking just a few minutes ago about this journey that you're on. Obviously, you have deep experience in acquiring businesses over your career, but you've created a pretty interesting debt structure to be able to acquire the next round of businesses you want to be, you add to your portfolio. So I'd love, just for this room of future acquirers, how have you identified capital throughout your career, and then how have you pivoted into this most recent kind of aggressive approach at we're going to go spend some real money to acquire?
Yeah, very good. So in the first 7 deals that we did, we were very creative, right? Predominantly, those were opportunistic deals, local operators who were looking either to get out of the business, they were moving out of state, wanted their clients and their people to have a safe landing spot. And so we structured creative deals with, small amounts of cash, with, call it profit share, over 2 to 3 years payout on retained accounts and that kind of stuff. In some of the later deals that we did, we did use a little bit of bank debt for some of those deals as well. And after we bought 7 of those and integrated them all over about a decade, we decided that we had kind of proven our model. We were ready to really scale it, and so we went to market, looking to essentially raise adequate capital that we could have a blank check, right? That we could execute our strategy quicker, more nimbly, buy the right type of assets without having to raise for every single acquisition, right? And we went about it over, really, if I'm honest, 3.5 years really is what it took, and hundreds of potential capital providers that we spoke with, 2 commitments that didn't actually deliver. Therefore, the 3.5 years, the latest round took just over a year, and speaking to over 100 potential capital providers. In the end, we were able to partner with a fantastic private credit bank out of New York. They've been really great partners so far, predominantly former owner-operators, founders that wanted to create a more minimally dilutive, founder-friendly category of capital, right? So, with them, their name is Metropolitan Partners Group. We've essentially created a mini fund, $60 million. It's a 3-year structured facility that we have now to draw upon for acquisitions and organic growth initiatives. Hopefully that's helpful, Brian.
That's great. What 3.5 years to put that together? What do you wish you would have known that you know now when you started that process?
Man, I can tell you, with having spoken with several hundred, and I lost count. I mean, I don't want to exaggerate, but probably somewhere between 250 and 300 total, potential investors or capital providers. The power of story and really knowing your numbers, knowing your business plan, the strategy, being able to confidently articulate what you're doing, building the team. We just raised, a class of capital that has never been deployed in our industry at this size, right? It's never happened. A founder-owned, founder-led MSP or MSSP across the nation has never raised $60 million in debt to execute an M&A roll-up strategy, right? And I can tell you, it took a hell of a lot of discipline. It took building a really fantastic team that is very aligned with our mission and our vision, that is, purpose-driven, values forward, and it took really nailing our business model, nailing the client outcomes, the people outcomes, the financial outcomes, and being able to show that we have a very strong business, that we know what we're up to, we know how to source, how to work through deals, how to close those deals, integrate them in an accretive way, that we know how to grow those books of business that we acquire. We know how to operate them. We know how to empower them with our engines, right? Our operational excellence, our sales and marketing engines, our client success engines. And so, I think the biggest thing I learned, Brian, is just that you really got to have, unless you have an astronomically great idea and you're raising venture capital, you've got to have a fantastic business that's producing real world outcomes, especially in today's market, or raising capital is going to be challenging.
That's great. Crystal, for the acquirers in the room, many of them are on this journey to identify, source, start conversations, identify businesses that they want to buy. When you hear the word lender ready, what does that mean to you as a funder?
I'm probably speaking more to a first-time buyer or somebody just starting out. I would say, number one, have your numbers, just like you said, have your financials in order. So many times, they put everything together, bring it to a lender, we're going to take it to underwriting, and we have nothing but spreadsheets. So it's first and foremost important to have all the financials in place. Number two, I would say, is I know that a capital raiser is not going to look at this, but we will look at credit. Some of our lenders actually do a combo business credit and personal credit pull, so that's important to look at. Having a story that you've crafted and a vision that you can put into either a business plan or down on paper to really help us understand what you're trying to do. And then I think, the other thing is, I believe you should do your valuations on the business first. You can do preliminary valuations, so they're different than what an institutional lender would do. But having that done ahead of time, so it gives you negotiating power when you're purchasing, I believe is a very important thing to take a look at.
So looking at it from the other direction, what are some of the big missteps that you've experienced or seen, or just really make it hard to get behind something that somebody that's coming to you?
Well, just as I said, if you don't do your due diligence ahead of time and you put a purchase together and it's something that we're not going to be able to lend on because it's, we're not going to get the valuation that we need, that does happen quite often. So I think that's first and foremost very important. And the second piece is, if we can't put everything together to understand what you're trying to do, that also will kill a deal sometimes. So crafting your story is very, very important. And again, back to financials, I'm sorry to keep repeating, but that is what our lenders are definitely going to look at. So if you can't give us more than a spreadsheet, we're probably not going to do the deal.
Do you advocate for buy-side Q&A before QV before somebody gets to you, somebody that has really gone deep, almost depth of audited financials? How deep do you need to get for a lot of your buyers to feel comfortable with the diligence they've done?
I'm sorry.
Quality of earnings, or how deep, maybe more broadly, how deep do you need to get comfortable in the diligence that's been done on the financials for you to feel really good about an investment?
It really depends what type of business, or if it's a commercial piece of property. So typically we're going to go back 3 years on any either side, any business or piece of property. As far as a new purchaser, we're going to be looking at your personal financial statement. Sometimes we'll go with just 2 years, but that's really what we're going to be looking at.
Thank you. So Steve, what have you found to be some of the best ways to access capital, in your experience?
I think a key component of accessing capital is deal structure, right? And you need to know, the valuation of the assets. You need to know the valuations of the businesses, and you need to craft a deal structure that is going to get you to a yes. I think, oftentimes, at least especially early in my career, we would go to a lender, say, hey, we've got this great, unbelievable deal. We only need 4 times earnings. And they kind of just laugh at you, right? And then you have to go back to the seller and you have to renegotiate, right? And so renegotiating a deal or retrading a deal is often the fastest way to kill a deal, right? So you have to be forward thinking in how you're putting a deal structure together. You've got to understand the seller's motivations, the tax implications, the entity structuring. You've got to really understand all of that before you ever go look for capital. If you're looking for capital without that whole story, detailed out and having a very good foundation underneath of that with you and the seller, or if you're the seller and the buyer, you really need to understand that. And then obviously in more recent times, you also really need to be very careful with all the new covenants around SBA loans. If you're a seller and you're selling to a buyer who wants to use SBA, or if you're a buyer, you need to understand the seller's, ability and willingness to participate in the debt transaction. So I think it's just really, ultimately, you got to really know your deal, and you got to really have a solid deal. You can't just have an idea of what is going to get the deal done. You really need to have an agreement in place, and it needs to be very solid.
And obviously, we've been through a lot of different ups and downs in the last 5 years, and when it comes to capital markets, what's your view of where we're at today in that process?
I think the trend globally, and I'll speak private equity because that's really, I don't do a whole lot in the venture capital world, but on the private equity side, at the larger echelons, we're still sitting on over $4 trillion of dry powder out there chasing deals. So it's pushing a lot of people down market, right? So there's a lot more capital chasing the smaller and mid-sized deals right now because they can't compete with, guys that have, a $500 million or $1 billion or $10 billion of dry powder, right? So, for most of the people in the room, I think it's just, it's understanding where you are in that economy, if you will, and optimizing your approach, and to Earl's point, you gotta kiss a lot of frogs.
Yeah, that's right. Dustin, we heard valuation a couple times already. I guess tell us a little bit about how you value businesses, the different ways and methodologies used throughout a process. We've heard of revenue-based, EBITDA-based. There's a lot of different ways to look at a business. How do you think about that?
Yeah, no, great question. Just out of curiosity, just by show of hands, how many people, as part of whether you're a broker, a buyer, a seller, how many people in the room right now are doing their own valuations on a somewhat regular basis, just so I can get a sense for the crowd here? Okay, leave your hands up. Put your hand down, okay? Put your hand down if you are not using an approach that relies on some kind of market multiple. Yeah. I don't think anybody put their hands down. So that's kind of the typical way when you're looking at buying or selling a company, right, is there's going to be some kind of multiple based off of earnings, typically EBITDA or bankers' cash flow, or depending on, maybe it's a specialized industry like a SaaS company that has no earnings, and then now we're talking about multiples of revenue. So that's like, we appraisers, we refer to that as the market approach. Okay, we're basing that on actual transactions that have happened in real life in the space that were negotiated at arm's length between a willing buyer and a willing seller, and that's the ideal way to base a valuation. It's also very straightforward and easy to understand, right? You just got to know your earnings, You got to find a multiple, whether you did some research to find that multiple or you negotiated it, and you just do some simple math. However, sometimes that approach doesn't work really well if, say, you have a really niche business and there just aren't companies like your business that are transacting. And so in that case, you have to get really creative and do some kind of valuation approach based off of earnings, which we call the income approach. And that approach, a lot of people, especially in venture capital, private equity, they'll start shaking their heads like, no, we don't do that. Doesn't make any sense. But it's the basis of finance. I would encourage anybody out there who's dealing with numbers on a regular basis, like get on a video and go on YouTube and search up Oswath Damodaran and learn how to do an income approach and understand the inputs and that go into that, because that might be your only option if you can't find good market data out there. And like Earl said, to be able to pair up a really strong narrative to a financial forecast is a really valuable exercise.
Yeah, I 100% agree. What for the owner-operators in the room, what are some of the things that maybe the most common missteps that you see when you're trying to value a business, or maybe some of the things that you wish more owners would be thoughtful about prior to coming to you for evaluation?
For, let's say, like businesses that are like under 10 million in revenue, you have focused on growing your company, and that's where most of your capital has gone. And in order to do that, you may have cut corners on the finance and the accounting side. So kind of echoing some of the comments Crystal made, I feel less motivated to work with somebody if their financials I know are an absolute dumpster fire. I don't want to audit your financial statements. I'm going to put a disclaimer in my report that says you gave me numbers and those numbers are represented to be true and accurate, and that's what I used. It's the ultimate CYA for me. So really be thoughtful about your financial hygiene. Are my books in order? Have I graduated from QuickBooks Desktop? That's we harp on it, but it's really important. Every person, investor, banker, appraiser, it's the first thing we're going to ask for is to see your financial statements.
Yeah, that's great. Maybe a question for any of you that want to jump in. There's a lot of M&A advisory firms, brokers in the room that are helping businesses go to market and transact. But I think oftentimes some operators don't understand that actually raising capital to do it in reverse, to actually acquire businesses to drive growth before they have their final transaction, is an option. I'd love any perspective on that decision tree as an owner-operator when maybe it's time to think about selling versus I could actually go raise some capital in a variety of creative ways and actually grow this thing to be much bigger than it is today and have a better financial outcome.
I think, Brian, there's following on Jamie's presentation about sitting in consciousness, right? I think that should be a really conscious decision. What I can tell you, with nearly 3 decades operating and growing a business, is that you as the founder or founders or senior leadership team, right, and principally you as CEO, if that's the seat that you're in, you will bottleneck the ability of the organization to be able to grow based upon the pace at which you are willing to grow as a business leader, a people leader, and as a person, right? And so because you grew your business from 1 to 5 million a year, for example, in revenue, doesn't mean that you're qualified to grow it from 5 to 50 million, right? It doesn't mean you're qualified to grow it from to 10 million even, right? Most of us in our industries have natural ceilings, and granted, I've ran into those natural ceilings multiple different times in my industry, and I've had to, make conscious decisions about whether I want to acknowledge that somebody else can probably grow this business better than I can at this point, or if myself and my team are willing to look at ourselves in the mirror and to challenge ourselves to grow at a pace that gets really uncomfortable, right? And so before you go, and start doing M&A, I would make sure you know what you're getting into. M&A can kick the shit out of you. Like it can be really great, but it can really hurt you in your business. And 8 transactions now in, we've done some really great transactions, and we've done some transactions that were really rough, right? And you learn from those transactions. My advice would be, if you're going to consider to grow through M&A, surround yourself with the right advisors and the right team, right? An M&A advisory firm, the right legal counsel, the right accountants, the right advisors who have been there and done it before, right? And potentially, if you can get some of those people on your executive team, which is the approach we've taken. Our CFO has done, he's been involved in a couple hundred transactions throughout his career. Speaking of financial modeling, and telling your story with your forecast and all that kind of stuff. Our chief people officer has done several dozen transactions in his career. And he's critical for us in understanding the people dynamic fit, the culture fit, the leadership philosophical fit, and then how we're going to integrate those organizations into ours. Acquiring businesses and operating them or integrating them into your business, and sometimes you're not going to integrate them. It depends on, Steve, you're buying and operating independently businesses as a fund, right? If I understand correctly, and that's.
Yeah, they do somewhat stand alone, but it is all rolled up into an operating company, right? So there is the integration challenges that come with them, and like you said, some are good, some are bad, some are right down the middle. But there's always going to be a lot of challenges around that.
Yeah, know your game plan, plan for it, surround yourself with the right people, and absolutely expect that it's not going to be like organically growing a business, right? And that you are going to need to learn and grow and be committed to that, and facing your own weaknesses, right? As an owner operator, as a person, and being willing to challenge yourself to overcome all the time, right? Those would be my words of advice.
Yeah. Anybody else?
Yeah, I'll add. I'll go back to my prior comments, which is, if you're trying to get to a certain valuation and you need to grow, through growth of acquisition rather than organic, just be creative in putting deal structures together that are going to use a limited amount of your capital or leverage wherever you can, because if your ultimate goal is to do a couple of acquisitions now and then get to an ultimate exit for the overall portfolio, you need to be in a position that total exit is bankable, right? And so you always need to preserve your bankability for your big exit when you're trying to do these smaller acquisitions to kind of build the portfolio. So I think it's very important to be creative in your deal structures and to really preserve your debt.
Thank you. Yeah, Earl, going back to something you said really resonated, this idea of knowing yourself, knowing the strengths of your team and what you're capable of. In my last business, as we grew to a pretty real business, it got really fun to entertain our own acquisition kind of conversations with others that are in the industry that could be additive to what we were building. And we literally had no idea what we were doing. And it created 24 months of pain and suffering and confusion and wasted time and unlimited meetings to get to the point where we realized we had literally no idea what we were doing and we were never going to acquire any of these businesses. And so not until we brought in an experienced CFO that had been in the walls of Thoma Bravo for a decade, did we really understand what this world was like, and completely changed the way that we went through that process. So I totally get that. I think awareness and understanding of who you are, the strength of your team, where you're trying to go, and really be introspective is really, really powerful. How are we looking on time? Do we want to take some questions?
Yeah, let's do it.
Who has questions for this group?
I can start with a question.
All right, thank you. Reed.
When business owners are looking, what do you think is the biggest challenge that business owners have when they're actually doing a transition and doing an add-on acquisition that maybe they don't realize at the front end of things?
I think you might have the best.
I'm happy to defer to anybody else that wants to answer as well. Really coming back to something that you mentioned, Brian, when you're building your own business organically, you've got to get really good at hyper-focusing, right, on your core and how you're delivering the outcomes that your clients require, that the financial picture of the organization requires. You have to understand, if you're going to go and start doing M&A, you're taking your eye off of that prize. And it can be critically disastrous if you aren't ready to do that, and if you don't have enough cycles, in leadership, bandwidth, thought, your team's ability to be able to support the strategy and execute it, right? And oftentimes that's going to mean that you need to build, you need to start building some new teams, right? An M&A sourcing team, maybe that's the team that's also working through the deals, a team that's doing integrations. Again, this is a whole different ball of wax than building, your own business organically. You have to figure out how to make sure you keep your eye on the prize, that you're continuing to deliver the right experience to your people so they can deliver the right experience to your clients, so that you're producing the right financial outcomes while you also are diverting attention towards another strategy. It's a challenge. It's not easy. I definitely advise that you make sure that you know what you're getting into on that front.
Any other questions? Maybe I'll pose one if we don't have one for the crowd. For any of you thinking about acquiring or raising capital for an acquisition, what's, if you could go back 5 or 10 years in your career, what's something that, again, you wish you could rewind the clock and teach yourself, a lesson that you learned, or an explosion that you had on the goal line that you wish that you could redo or relearn and avoid some pain?
I'll answer that one. I mean, it's you have to expect the unexpected, and you have to understand that everything that can go wrong will go wrong, and you have to try to game theory all of that out in your head and with your team, and you have to really dig deep and ask yourself the tough questions that you don't want to ask. That would be my advice.
That's right. I think, on the advisory side, we talk to a lot of searchers that are looking to acquire their first business. And I think one of the most difficult areas that we struggle with is you build rapport, you validate the concept. There's a transition plan that seems validated. There's an agreement on kind of deal structure and valuation. And then you get to that uncomfortable moment of, all right, do you have the money, right? Proof of funds becomes an awkward conversation. And I can't tell you the number of times where we've gotten a little bit too close to completing a deal, and that proof of funds kind of disappears as you get close. And as we talk about deals exploding in the goal line, we've seen a couple of these examples of transactions that we thought were incredible buyers that were right there, but at the end of the day, they couldn't get funded in the way they thought. Love anybody that's seen or experienced that themselves. Crystal, have you ever had to have that difficult conversation with a first-time buyer that had identified an asset and you just couldn't get behind it financially?
So just step in front of the chairs when you pull them off.
More than once.
Too many times?
Too many times. Most often, it's all due to a lack of preparation and a lack of being able to really give us the vision of what you're trying to do, as well as, of course, the numbers. But I just can't tell you enough that you have to be prepared and you have to do all your due diligence up front. If you come to the table and you expect us just to piece things together for you, it's never going to happen,
Thank you.
to be honest.
Any other questions from the group?
One of the situations that I've run into, Shiloh Sorensen, Murphy Business, intermediary, is realistic expectations. One of the things that I've run into mostly in the last 3 to 4 years is the MBA program is providing this entrepreneurship through acquisition. And what they are teaching doesn't line up with what these young people can afford. So they go through the program, they're looking at companies that have financial, that they have audited financials, or they have reviewed financials, and then they come into the market and they're looking for small business, and these small businesses don't have those things. They have compiled financials is what they're called, right? You're talking about QuickBooks experts or lack thereof. And they're not really apples and apples. And so I'm assuming you're getting these same people coming to you, asking for funding, and not really understanding what they're dealing with small business. And these small businesses are your Main Street businesses, anything probably under the value of $5 to $10 million. Well, you got to have $500,000 to $1 million liquid to purchase a $5 to $10 million business. Most of these MBA guys are now $400,000 in debt, don't have that kind of money, and so they have unrealistic expectations coming out. How, as a funding group or as you deal with that, do you kind of re-educate them and kind of help them to understand what they're looking at in small business is not going to be audited and reviewed financials, and what they actually can afford, they need to kind of realign themselves with what they can get on the market.
Anybody?
Well, I think maybe I'll comment. I don't know that I'm answering your question. I think one of the gifts when it comes to M&A advisory and brokerage is this new upstart of buyers that have come out of MBA programs, but it's also the biggest curse in the trying to identify professional buyers. We've all had our professional experiences in which you can't get experience until you get experience, but we really struggle with buyers that aren't deemed to be professionals, that haven't been an owner-operator prior to. It's not enough to say I went to Stanford. I need a business with $2 million of EBITDA, and I have a rich uncle that's going to fund me. It just doesn't. Unfortunately doesn't fly very very far. And so I think that's really, from my perspective, I'm open to anybody else's answers. It's tough to tell somebody that is so excited that this may not be the right business for you to acquire, but it is the reality sometimes.
I can give a firsthand story. So we were involved in a transaction recently where it was one of the big national brokerages that were representing the seller. He wanted to run a very traditional process. Hey, IOIs and LOIs are due by this time, and then we're going to review them, and then we're going to pick 3, and then we're going to move forward. And they weren't letting anybody even spend time going out to see the facility, the machines, the equipment, the actual tangible assets of the business. And it got to a point where the seller clearly had an affinity for us in the transaction, but the broker was leading them down the process. And I started just asking questions to poke holes, and I said, well, has anybody asked you this? Has anybody set foot on this? Have they seen this? Have they evaluated your processes and how your business works? Do they know the first thing about making your widgets? And every time he was just like, no, 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 no. I said, okay, so you're a smart guy. What are the probabilities that you think that one of those three people that just gave you an outrageous offer for your business are actually going to close that deal? And, unfortunately for us, he decided to listen to his broker, but, to my knowledge, that business is still sitting on the market right now. Because, anybody can look at a spreadsheet and, go to, their favorite AI, software and say, hey, what's the valuation of this business based on these numbers? And they're going to get an answer, right? And then they can say, well, hey, I know there's 15 other people bidding on it, so I'm going to go in 20 or 30% higher. But at the end of the day, is it bankable? Are they going to be able to get the debt? Do they understand the collateral requirements? Do they actually understand the valuations? Are they going to do a quality of earnings analysis? There's so much that goes into getting a transaction across the finish line that this kind of generation of MBAers, they just don't have the actual experience and the transactional history, as Earl alluded to. And so for anybody who's in this space, just if you're a buyer, understand how to separate yourself from the crowd, right? And if you're a seller, understand how to sift through the crap.
Yeah, it's actually a really good point that you bring up, because a lot of buyers don't understand that debt lender is actually going to look at, can you operate the business? Are you somebody that has any of that industry experience? So that's an important thing to know right off the get-go. If they don't, what I try to do is help somebody put a strategy together. Maybe you have to bring a partner in. Maybe, if you get the education up front and you sit down with somebody like one of us who can help you strategize before you get to the point of deciding what business you want to buy, that's going to be the best alternative for you. The other thing I would say is, if you are going to bring a partner on, of course, everybody in here knows, just take your time and do your due diligence with that as well. But yeah, very good point you bring up, because a lot of times they think if they're buying a business, we're only going to be looking at the business financials, the business operations, but no, we're going to look at the buyer and whether they can operate the business.
Well, I think we're out of time, but thanks to each of you for joining me today on the stage. It's been a pleasure, great conversation, and looking forward to the rest of the day.